I'm so happy to finally be able to sit down with both of you face to face. I really enjoyed the phone conversation we had a few weeks back, and I really think that there's something here that can be beneficial to all parties involved. I know how stressful and hectic the entire retirement plan process can be, and it's my job as a financial planner to offer you guys peace of mind when it comes to this process and remind you guys that there's a structure in place to make sure that everything flows through. But before I get into anything, I know that you two just got back from your trip from Europe, so how was that? Where'd you guys visit? Wow, Poland. Well, my mother's actually from there, so we actually have a plan to go there next summer, which I'm very excited for. I've never been, so I'm looking forward to that. But what did you guys do there? Lots of hiking? Nice. I've heard that there are many beautiful mountain ranges and other scenic areas to visit, so I'm sure that you guys were plenty busy and had an excellent time. But what I have here for you today is a comprehensive financial plan report from all the questionnaires that you sent in and the information I picked up from the phone call, which pretty much goes through your entire financial profile, its strengths, its weaknesses, and is summed up at the end with an action plan of recommendations that we believe you guys should follow through with. But even if you don't continue on with our firm specifically, just these are things that you should ponder going forward because they definitely would aid your financial situation and kind of give you more peace of mind when it comes to that. But it started off with a summary page of just some stats that and your goals, tolerances, and such. And I'm just gonna run through this real quick. If there's anything wrong with it or anything incorrect, please let me know. But John, you're 71. You just sold your manufacturing company. Congratulations. I'm sure you're very proud of yourself. I heard through word of mouth that it was a very successful firm. And yeah, like I said, you must be very proud of yourself. Congratulations again. Mary, you're 68. You just retired last year. You two have two children, Edward, 42, and Brent, age 40. How's Edward doing? I know in the phone call you told me he recently got divorced. And I have a friend who's going through something very similar right now, so I know how painful and how difficult that situation must be. If he needs anything whatsoever, any kind of financial advice or needs someone to talk to, please send him my way because I would love to be of help to him. I know how difficult those situations are, so please, if he needs anything, don't hesitate to call me. You two have three grandchildren, Jack, age 19, Eugene, age 10, and Beth, age 11, and everyone's in good health, which is wonderful news in today's day and age. Your goals through the questionnaires that you guys wrote out for us, you want us to reduce or limit any estate and gift tax liability, ensure that all your estate plan documents are in order, review your insurance contracts, and discuss a long-term care policy, of which I found a policy that I believe is suitable for you two's needs, of which, however, I need to be full disclosure with you. You were referred over from your insurance agent, of which, if you two become my client, there's a referral or recommender payment that's processed between the two of us, of which I don't see this as a conflict of interest or an issue whatsoever. I'm sure you two have been with him for many years and are very satisfied with his work, and he's a personal friend of mine as well. And he's a very, very strong insurance agent, and he's a very honest and trustworthy one as well. So I don't see this as an issue. But if going forward you do become clients of ours, in the written disclosure, I'll have this listed just that you guys can sign off and say that you're okay with it as well. And you want us to reduce your income taxes because I know that there's a large tax liability coming in, especially considering the sale of John's business. And based on your risk tolerances, recommend a diversified portfolio to meet your needs, of which I took a look at what your current portfolios are and made some recommendations based off of those. But based on your questionnaires, you guys have a moderately high risk tolerance, and you also have the financial backing to support that, of which we have three categories: conservative, moderate growth, and aggressive growth. You'd be somewhere in the middle, more towards moderate growth, which is a blend of stock exposure and a little fixed income just to make it more conservative than aggressive growth. But aggressive growth for ours is a lot of stock exposure. However, based on your investing history, we wouldn't, in your current position in life, we wouldn't recommend that you are overly aggressive. So we'll go through everything, and when the time comes to actually make a template for you and recommend specific investments, we'll run through that then. But just some basic assumptions. You guys are in the highest tax bracket right now, which is currently 44% state and federal. The risk-free rate of the market is 1% of the market risk premium, 7%, which all that means is that the market's averaging 8% per year annually. That 7% of that is due to the exposure to risk or the exposure to investing in equities, where 1% of that is from natural return you would get from risk-free investments such as government bonds or something in that area. But that's not important. That's mainly more for the calculations that we did in terms of calculating your risk-adjusted returns of your portfolios. But the inflation rate right now is at 2.25. However, we expect inflation and interest rates to rise in the short term and long term, of which this has ramifications for the recommendations we make for your investment plan. But like I said, we'll go through that a little bit later. Going forward with your financial health, we calculated net worth statements and a cash flow statement for your disposable income, and we came out with a net worth of about $13 million for you two, with current net disposable income of $1.2 million, which clearly indicates that the cash situation is not an issue, which you relayed to me, which you're more concerned about the tax situation in regards to your income, which we'll run through that at the later part of the plan. But we just calculated some basic benchmarks and ratios to go through your current cash situation, and we came up with a current ratio, which pretty much just looks at your current assets, your current liabilities, or the liquid assets that you have at hand, like cash, checking, savings, over your current liabilities, current credit card debts, mortgage payments, and stuff that you pay within the next year. And this ratio should be above 2. Yours came to about 40, which clearly indicates that you have plenty of cash. However, the large chunk of this was from John's CDs, and there's an interest rate penalty if these are touched before maturity. So in the case of some emergency where you need a large cash chunk, or you guys decide to make a renovation to your house or whatnot, this should be considered as something that might be an issue, because you only have $50,000 between your cash, checking, and savings. And I remember you guys telling me that you have a liquidity need of $40,000 to purchase a new car, net of trade-in value. So this will only leave $10,000 for all this extraneous activity. So I recommend that you guys build up a bigger cash net, either from just keeping cash for the income of the installment payments of John's business, or I also made a potential method recommendation of selling certain securities in your stock portfolios to harvest tax losses, which will then free up cash. But we'll run through that in the investment section. In terms of your insurance policies, we ran through a scenario analysis of John's annuity, and this would pay about $150,000 over 25 years if annuitized, meaning that the entire value of the annuity is paid over a monthly payment over the period. So in this the current period for John's life expectancy would be about 25 years. So this would give about 300 payments of $500 each, of which a large chunk of this, because of the cost basis on John's annuity is very low, would be income taxable, which is taxed at your current highest tax bracket, which in your tax situation would just be creating more of a headache. So we also came up with a scenario that if you were to gift this to one of your children or grandchildren, what the tax ramifications of this would be. And with fair market value at $102,000 and electing to gift split between John and Mary, which all this means is that instead of the gift coming solely from John, that it would come equally from both of you. And this kind of divvies up the tax ramifications of it. It creates a $70,000 taxable gift net of the annual exclusions, meaning that every single year you can gift $16,000 per person, per recipient, meaning that each one of you can gift $16,000 to each of your grandchildren every single year, and there's no gift tax ramifications behind it. However, when you go over and above this, it starts eating away at your lifetime gift tax exemption, of which it's about $12 million currently per person. So this gift would result in about $35,000 per person that goes over and above and beyond this exemption, this exclusion. But as I said, you have $12 million of exemption in your lifetime, which is connected to the $12 million of estate tax exemption. But this reduces that when you gift above and beyond and you use your gift tax exemption for that. So this is not a tax issue now. If you end up in the future gifting large amounts to your children or your grandchildren, that this is something that should be dealt with your CPA. But there's no issue with it right now. However, it would also trigger a $35,000 generational skipping tax, which is an additional gift tax on top of the fact, because you would gift if you gift it to one of your grandchildren. However, in the same way that a gift tax has a $12 million lifetime exemption, so does this generational skipping tax. So there would be no current tax implications for it. But like I said, in the future, if you guys decide to gift a large amount of your estate to your children or your grandchildren rather than leaving to them at your death, then this could create some of an issue. But you should talk to your CPA about this, because he will recommend a more structured plan if the need comes. But like I said, right now, there's no issue with it. Your homeowner's policy on your vacation home is fine. It covers enough amount. However, on your primary residency, it's very insufficient. The way that homeowners insurance works is that it covers about 80% of the fair market value of what the entire building of your house is worth. And with your private residence, the actual building being worth $775,000, the needed face value on the policy is $620,000, but your current policy is only $400,000, and this $220,000 shortfall on $100,000 loss would create a $35,000 policy reimbursement. That's lower than what it should be. So I would definitely look into this and definitely get an upped policy in order to meet this, because God forbid some disaster happens, you don't want to be left blind and having to cover this additional $35,000 shortfall. Your auto policies look very sufficient. However, the only issue is that you two have no umbrella policy in case some emergency that occurs, which goes above and beyond what your auto policies will cover. With all the drivers on the roads today, you don't want to be at jeopardy in case something happens, that you're in the hospital for a very long time and your medical bills are all out of the roof or something happens. So I would recommend a umbrella policy of about $2 to $3 million of protection for both of you total. And I feel like this would be sufficient for that, just in case something happens, because like I said, it's better to be safe than sorry. Your health insurance seems all in check, and your life insurance policies are more than enough given the other assets that you have currently. With your investment situation, you have about $3.8 million of non-qualified assets or after-tax money between your stock portfolio and mutual fund portfolio, and you have about $1.6 million of qualified money through John's 401k and Mary's 403b. On the stock portfolio, we found that you guys are underperforming on a risk adjusted basis, meaning which we pretty much we ran a Sharpe ratio, which pretty much is the risk, the return that's above the risk-free level of 1% that I told you, based on the standard deviation of what the account does or what the market does. And right now the Sharpe ratio of the market is about 0.63, and your account was only about 0.61, which shows on a total risk-adjusted basis you guys are underperforming. And I feel like this has a lot to do with the fact that it's so clustered and it's not really diversified. I mean, the entire amount was only invested in 4 companies, of which almost half of it is invested in one company, stock D. So I came up with a plan of which helps your tax situation at the same time kind of diversifies the portfolio. Stock A has about a $200,000 loss, which, as I said earlier, you guys could sell this and capture that loss. And because it was held for more than a year, it counts as a long-term capital loss, which on the sale of John's business, the majority of that gain is long-term capital gain because John held that business for more than 1 year. So on all those installment payments, part of what you're getting back is what the actual his cost basis in the business was a return of it, and the rest of it is just long-term capital gain. So steps that you guys could take to sell long-term capital losses would offset this gain and reduce your tax liability. So this is something that could be done. You could sell some of stock D, which, as I said, is the largest amount of this portfolio right now. And it's also the smallest gain of any of the stocks in this account. And it's really prudent to go forward with a diversified after-tax portfolio, because on your pre-tax money, the 401k and the 403b, if you were to tap these accounts, any distribution from them would go above and beyond what your highest federal tax level is. So these get added on top to whatever the top tier tax bracket that you're in, and you pay taxes on it. Whereas with your after-tax money, because these stocks have been held for over a year, they count as long-term, meaning that they're held to only being taxed on the actual gain portion of it. And the tax brackets on those are 0, 10, 15, and 20. Whereas with your current federal tax bracket and state tax bracket being 40%, this is well above what the long-term capital gain tax brackets are. So it would be prudent to go through, and especially because, as I said, over half of this account is invested in a single stock. You don't want to be held to exposure of if one company goes belly up or if there's significant issues with that specific company, that the large chunk of that portfolio is going to be affected. And I know that you have a mutual fund portfolio as well, but it would be prudent in this account just to diversify and invest in more companies. And if there's high conviction in these companies, then we most certainly can keep them. But I would recommend that you diversify that account. Going forward with your mutual fund portfolio, while it is diversified, there are certain changes that can be made to it in order to kind of take advantage of certain economic and market situations that we believe are going to come forward. With interest rates and inflation expected to rise, certain areas of this portfolio are going to specifically struggle. And specifically, that's the growth and the bonds sections of it, which accumulate total about 20% of the total portfolio. The issue with these areas is that when interest rates rise, bonds specifically are priced inversely interest rates. So when interest rates rise, the prices of bonds decrease. So this bond fund will struggle immensely as interest rates rise. The growth section of it is an interesting display, which I'll explain the difference between growth and value if you guys don't know. Growth companies are companies that are very high-flying. They're expanding rapidly. Companies give a thing called a dividend, which are paybacks on their shares. So if they have extra cash lying around, they'll pay it out to their shareholders, or they'll invest it back in the company. Growth companies typically invest it back in the company. Value companies are older, more mature companies, which they'll pay out because they feel as if there's really no need for more investment. They'll pay it out to their shareholders. Now, the key is that the large amount of valuation in growth companies is tied up to future earnings, whereas with value companies, it's really current cash. And when interest rates increase, especially at a large rate, the discount rate, or is the rate of which future earnings are discounted or decreased in terms when you're creating a stock price, increases. So growth companies, the valuations of them are hurt much more than the valuations of value companies. And you really have no value exposure in this portfolio. So I would recommend adding a significant value exposure, because it's going to outperform the growth exposure. And kind of you can even, if you want to keep the growth exposure, you can kind of go with a more blended approach, which is 50% value, 50% growth. But going entirely growth on this and using, even with the balanced fund, within it, there's a very high growth exposure. I would just recommend that you're reducing that growth exposure because, like I said, it's going to struggle to appreciate when interest rates rise. And with the bond fund, we can find an alternative that really is not impacted terribly by interest rates and will outperform a traditional bond fund, where there's other alternatives for fixed income that we can find for you, and we can even find one that is more tax efficient. But most important, you have a very significant amount in the 401k and 403b, and this is all pre-tax money, which is going to get, as I said, is going to get added above and beyond what your current highest tax bracket is, and any distribution from this gets taxed at the highest tax bracket. And going forward, this all counts as taxable money. So if the accounts today total $1.5 million, if they were to double to $3 million, now you have $3 million where if you took out the entire amount of it, it would all get taxed. And this doesn't, whereas your stock portfolio, your mutual fund portfolio, when you two die, they're left to your children at a stepped up cost basis, so they would not pay any more additional taxes on it, and their tax liability on it would actually be nil because it's left up at a stepped up cost basis, meaning that their cost basis is stepped up to the fair market value the day that you die. However, with these qualified accounts, it all counts as income for them, and they're actually, because of a new rule that was passed a few years ago, forced to take these accounts out over a 10-year period. So this would add a lot of large taxable stress to them, and I know that one of your goals was to really grow money tax-free. So here's a plan that I came up with, of which you're gonna have to run this through with your CPA to see if it's really something that is interesting and is something that you guys can really handle it, because I don't know how much your ability to pay taxes is right now, or your willingness to pay taxes right now is. But there's something called a Roth conversion, of which if you took these accounts and converted them over into a traditional IRA, which is a traditional individual retirement account, you can now convert these over to a Roth IRA, which, while you would have to pay taxes on the entire amount of these, now anything that grows in the Roth is tax-free, tax exempt, and is left to your children tax-free, tax exempt, as long as it's held for more than 5 years. So this means that you get $1.5 million of additional taxes on what your current tax bill is, but now in the future, say you guys live for another 30 years and these accounts grow from $1.5 million to $15 million per se, you avoid a lot of taxes in the future. So I know it's a difficult pill to swallow. It really goes back to the question of, are you more willing to pay taxes now or spread it over time? And we can even do this conversion over time, because you can do a Roth conversion every single year from the traditional IRA to the Roth IRA. But I would recommend rolling these over from the 401k and 403b into IRA accounts in you guys' name, because the IRA offers many more investment options, whereas this 401k plan and the 403b plan, they're very limited investments of total funds that you can invest in, and I don't believe that they allow individual equities to be bought either. Whereas in an IRA or a Roth IRA, you can buy pretty much anything under the sun, and it really offers the largest investment opportunity, and really offers a big way to increase your appreciation of these accounts, because right now these accounts are they're both invested in a single fund each, and there's not really much opportunity for outperformance in these accounts. But if you accept our recommendations in the future, over the next coming weeks, if you're interested, we'll go through and make specific templates for you and a specific action plan in regards to your investments of what we think you should buy and how we would have the money invested if you're interested. Going forward with your retirement planning, we projected out an 8% annual return into the future with your moderate growth moderate risk tolerance. And with inflation at 2.25%, this offers a inflation adjusted return of about 5.6%, which means that your spending power on this money is growing by about 6% annually. However, we project inflation to increase to 3% or 3% or higher in the future. So if we use 3% in this calculation, your return is still about 5%. So you're still getting growth on that spending power, which is ultimately the most important part of retirement planning, because you cannot afford to have a rate of return that's less than inflation, because now your spending power is decreased, and this creates issues for your retirement going forward. We don't believe inflation is going to stay as a significant issue going forward, especially at a very extreme rate, of which would jeopardize your spending power, the growth of it at least. However, if different changes of inflation occur, we would have to come back to the plan and reconsider it, and reconsider the risk tolerance on it, and maybe even have to go more aggressive with the money to get greater return to kind of beat out inflation. But like I said, you guys should look into the Roth conversion aspect, and we'd be more than happy to run through everything with you and go through the actual specific taxable ramifications of that if you guys are interested. But like I said, if these accounts grow significantly, of which I believe that you're on the verge of a very significant bull market, the taxable ramifications going forward will be much more significant than what they are now. It all goes back to, are you guys interested in paying the taxes right now or paying the taxes in the future? But I would consider this, and I would ponder this thought. We also looked into you guys' ability to invest in a IRA outright, and because your adjusted gross income is so high, you're not eligible to make deductible contributions to an IRA. However, because John still has $11,000 of earned income from this year, it's possible for him to open up a non-deductible traditional IRA and fund this. Because you guys are over 50, you can contribute of $7,000 annually to this, and John can actually make a $4,000 spousal contribution on Mary's behalf. And then going back to the Roth conversion, you can then convert these traditional IRAs over to Roth IRAs, which then grow tax-free. However, you'd be paying taxes on this additional amount as well. So if you were to put $7,000 in and you converted it, you add $7,000 to your total taxable income, and you have to pay taxes on that. But the growth on all of that would be tax exempt going through the future. So this might be something that you're interested in. And while it is not possible for you two to make qualified charitable distributions, because I know you guys also had a question on that from the 401k and 403b, it is possible if you were to roll them over into IRAs. And because John is 70 and a half, he would be able to make up to $100,000 of QCDs from his IRA, of which this is a potential method we could take to kind of deal with the fact that you two are getting up to the age that on this qualified money, you're going to have to take out RMDs every single year, of which, as I said, all distributions from these accounts go on top of your personal income and at the highest level. So this qualified charitable distribution, there's a way to match it to your RMD. So you're donating the entirety of your RMD, so you're not adding to your taxes, you're not adding to your taxable income, and it satisfies the RMD. So this is something that RMDs now, because of the Jobs Act in 2020, are now at age 72. So this is something that John has to deal with next year, and I would talk to your CPA about it. But in terms of your income tax planning and other tax situations, I know, John, you had a question of funding 529 plans for your grandchildren, what the tax ramifications of that would be. And as I said, there's a $16,000 annual exclusion per gift per person, per recipient. And you guys can mend those gifts together, meaning that you can give $32,000 per grandchild. And actually with 529 plans, there's a way of super funding it for 5 years, meaning that you can give 5 years worth of annual gifts up front, which means that it brings the total to about $480,000 given to all 3 grandchildren, or about $160,000 apiece. So if this is something that you guys are interested in, we can look into, and we can talk to your tax accountant about it. You'd also have to fill out the gift tax form that I explained earlier, the 709. However, the only issue is that all this money would be forced to be given in regards to the children's education, whereas if you opened up a unified gift to minors account in each grandchild's name and gifted these gifts to those accounts, you would not be able to superfund them. However, all this money and any gain made in those accounts would grow in regards to being used for any well-being of the grandchild. So this is something to be pondered about. But in regards to the sale of John's business, given the tax base of the $1 million of his cost base in the business and the $4 million total sales price, this gives out about $3 million of capital, long-term capital gain. And because of John's cost basis on this, about 27% of each payment would be made towards a tax-free return of his basis, and 73% of it would be taxable as a long-term capital gain, plus the additional interest on each payment. And the numbers are listed on here, and I'll give you a copy to go run through. But the main point of it is that there's a lot of taxable income that's going to come out of this. And the worst, or the not necessarily the worst, but the hardest to deal with is the interest income, because as I said, this gets taxed at your highest tax rate. So this creates the taxable issue. I don't know if it's possible, John, but I ran through another scenario of which you sell the business for $4 million up front rather than through the installment note. And with $2 million going for the building, $500,000 for the machinery, and $1.5 million going as goodwill that's grown over the years in the business. And this results in $2.9 million of long-term capital gain total, rather than having this long-term capital gain spread over 8 years and having the interest income on top of that, and creating a very long capital gain issue and tax issue. Whereas if it's upfront in the first year, like I said, you're biting the bullet, paying the taxes in the first year, but now you also get the ability to invest this money and have it grow over time, and the appreciation obtained over the 8 years rather than getting each payment, investing it periodically. It might be something to consider. But even if this installment note has to be done the way it's done, there's still ways to save taxes, because as I said, we can tax loss harvest from the stock portfolio in a way to limit the capital gains behind it. And I know you're interested in, if you were to sell your father's inverted Jenny stamp, which you received from your mother as a gift, what the tax ramifications of that would be, given a 15% commission on it. And because your father died when it was worth $500,000, your mother received that at a stepped-up cost basis, and because she gifted that to you, you received that cost basis. So your cost basis on it is $500,000, and if you sold it for $1.5 million with the commission, it would generate about $800,000 of taxable gain. However, because this was held for more than a year, it's a long-term capital gain, which is taxed at the maximum rate, of which in your case is about 20%. And we also looked at, if you were to itemize your deductions, where you'd be able to deduct from your taxable income, and you'd be able to deduct the $2,000 of interest on your mortgage payment, the $13,500 of the charitable donations. However, only $10,000 of the state, local, and real estate taxes can be deducted per year when you're itemizing. So your total deductible amount for your taxes would only be about $25,500, not the larger amount of, I believe, $60,000. So that's something to consider. In terms of your estate planning, you guys have a lot of assets that are listed to pass through probate, and this is going to generate lots of probate fees and create a big headache as this passes through probate court, I would recommend that you go to an estate planning attorney and retitle a lot of the assets that you own to be either joint ownership, which means that when one spouse dies, it gets left over to the other spouse with his half or her half at a stepped up cost basis, or other accounts that have a beneficiary listed on death, such as a POD or payable on death, or a TOD or transfer on death account, or specifically list a beneficiary so it goes there. You guys also don't have the paperwork in place for incapacity in case something happens to you guys in terms of having powers of attorney, healthcare proxies, and other issues. Now it goes to an estate attorney as soon as possible to get this dealt with, because this is a very considerable estate. And you don't want the estate growing to the rate that you're going to pay significant estate taxes on it. So there's methods that we call freezing the value of assets, of which you gift currently to trusts or irrevocable trusts or trust in your children's names, which kind of remove the different assets from your estate and freeze the value in terms of estate taxes and gift taxes to what it was on the day you gifted it rather than at the day you die. So any growth in these would be estate tax exempt, and it's something that I would consider doing immediately. This is going to cost you between $2,000 and $10,000. I have a personal friend who's a very good estate planning attorney, and if you're interested, I will refer you to him. He's very easy, and it'll make the entire process very smooth. But going forward, you guys, as I said, the estate planning issue is something that should be dealt with as soon as possible, because as the value of your assets grow, this estate planning issue of everything in probate, everything in terms of estate taxes is going to grow. So the sooner we deal with this, the sooner we create these irrevocable trusts and other trusts and other retitlings, the less these issues are going to be. I would also contact your insurance agent as soon as possible to get the homeowner's policy on the house up to the recommended amount, to buy the umbrella policy. And John, the long-term care policy that I found for you provides benefits of 3 years or $360,000, whichever comes first. And your insurance agent, him and I dealt with that, so he's knowledgeable about it, and he'll explain everything to you. But this would satisfy all of your insurance needs and would deal with all of those issues. I would also roll your qualified accounts into IRAs to offer more investment options in those, and I would also consider the Roth conversion. Again, please talk to your CPA about it, because I feel as if, given significant growth, these accounts are going to be much more of a tax issue and a headache going forward. And we can deal with this now, and it might not be pretty with the tax situation, but trust me, it's whatever you guys are comfortable with. But sometimes it's better to deal with issues and deal with taxes now rather than later. And the same issues with the estate, it's really important to deal with things current and before they become larger issues down the road. But also diversify your stock mutual portfolio, and our firm can come up with recommendations of how to do this if you guys are interested. But outside of that, I say, if you guys are interested in our services, let's meet again in 2 weeks and see how we can move forward. Very happy that we were finally able to meet together. I know that the client-advisor relationship is one of great trust, and I hold great appreciation for that relationship. And I think that this is the start of a very great client-advisor relationship. I think that our firm would be a perfect place for you too. Do you guys have any questions?